On this week's Market Perspective, we are talking about being your own bank through the use of margin loans and pledged asset lines of credit. When used responsibly, margin loans and pledged asset lines can help investors execute investment strategies and can serve as a source of flexible, potentially lower cost borrowing for shorter term financial needs. Margin lending for this discussion is different than margin trading. Margin trading has been in the news lately as increased market volatility has forced some traders to liquidate leveraged positions. To help us understand this topic, we are joined by Todd Stueve. Todd is a senior wealth advisor at Vector Wealth Management and has been working in financial services since 1998. Todd, thanks for being here. What is a margin lending and how can folks use it to be their own bank?
Thanks, Jason. Margin lending is a flexible line of credit that allows you to borrow against the securities you already hold in your brokerage account. For example, after working with her realtor and touring many homes for sale, Julie has finally found one that is just right. She will need $100,000 to cover the down payment on her new place. She has equity in her current home, but cannot access the money until it sells. Julie does, however, have a portfolio containing marginable securities. Rather than selling the securities and potentially triggering a tax event or being out of the market, she can borrow using her portfolio as collateral.
Okay, that's a great example. So when Julie sells her current home in a few months, she can pay off the margin loan plus the interest. What else is involved and how much does it cost to use margin lending?
Of course, terms will vary by lender, but if we look at a widely used custodian, we can get an idea. Typically, the interest rate depends on the balance borrowed and a base rate. Oftentimes, however, Vector is able to use our relationship with custodians to obtain a lower interest rate on behalf of our clients. To get a margin loan, you'll need to complete an application. It's a free service aside from the interest paid. From there, you can borrow up to 50% of the value of the marginable securities in the account.
Talk to us about margin calls and the risks, including the selling or liquidating of the collateral if the account value drops too much.
If the account drops below the minimum maintenance requirement, 30% for most securities, it can trigger a margin call or margin maintenance call. This means you'll have to deposit cash or securities into your account to meet the minimum equity requirement. Otherwise, you may have to sell securities in your account at the current market value. Couple of notes here. Just because you can borrow 50% of your account doesn't mean you have to. In Julie's case, she has $1 million of marginal securities in her account. She then needs to borrow only 10% on margin to fund that $100,000 down payment. Also, there is no set repayment schedule as long as you maintain the required levels in your account. Interest that accrues then is added to the loan balance.
Margin borrowing can be more cost effective than other lending options like personal or unsecured loans. I mentioned pledged asset lines, also known as PALs, for shorter term borrowing. Talk to us about PALs.
While margin loans are ideal for a 12-month period or shorter, a pledged asset line offers short or long-term liquidity needs for larger borrowing limits. A pledged asset line, like a margin loan, is a line of credit offered through a bank, allowing you to borrow against the value of your portfolio, usually at a variable interest rate. Assets are pledged as collateral and held in an account at a custodian. Unlike margin, these non-purpose credit lines may not be used to purchase securities or pay down margin loans, nor can the funds be deposited into another brokerage account.
Thanks, Todd. Really great to have you on the show. A few takeaways to recap. Setting up a margin account is straightforward and relatively low-cost way to access money for short-term financial needs. An alternative option that may be worth considering is using a pledged asset line or a PAL. Depending on where your account is held, it may be possible to borrow up to 50% of your account so long as you can maintain the loan-to-value terms. And you may be able to avoid a tax event by not selling and instead borrowing for these short-term time periods. Now, there's plenty of nuance and personal circumstances that goes into determining if margin loans or pledged asset lines are right for you. Please contact us with any questions and to learn more.